If you're able to move up, that would be good. If you'd like to sit in the back, that's fine too. But we're going to actually do something a little bit differently. Each one of the panelists will spend 5 minutes and introduce themselves and give you a context of the funds that they're responsible for, all within the context of long-term investing. And then we have 3 subjects that we're going to discuss, but we're going to actually, per subject, try to bring folks in as opposed to the notion of having questions at the end. So the 3 subjects that we're going to cover are 1, asset allocation, 2, risk management, and there'll be questions within that, and 3, sustainability. And so if there's particular aspects of those 3 questions you're particularly interested in, plan ahead. But that's, as I said, we're going to try to cover all 3 of those with audience participation as we go forward. I'm not going to introduce the panelists. Their CVs are in the program. They're terrific, as you can imagine I would say that, and we're going to get right to it. That's you.
It's me.
Yes,
Hello.
you.
Hi. Right, so I'm Stefan Dunatov. I'm the Chief Investment Officer at Coal, which is the investment unit that manages the old coal industry pension liabilities. It's a long-term investor in the sense that it's got lots of liabilities left for the next 20, 30 or 40 years. It is in run-off, so there's no funds coming into the scheme, but our challenge is a bit similar to actually some US pension fund schemes, in the sense that we have a fixed pot of assets that we need to make sure match off against a whole bunch of future liabilities. So we do our own ALM in-house, we do our own investment strategy in-house, and we do our own, if you like, manager search and selection in-house. And that's basically it, really.
Terrific. Torben?
And thank you for this opportunity to discuss issues of long-term investment. My name is Torben Möger Pedersen. I'm CEO of PensionDanmark, a Danish pension fund with 670,000 members, blue-collar workers from a number of industries. We are a defined contribution scheme. Contributions are decided at the level of social agreements between the social partners, employers' organizations, and unions. And at the moment, contribution rates are approximately between 12 and 15% of the individual wage, which means that we have yearly contributions of approximately 2 billion euro. Total assets under management is now 25 billion euro, and we are growing quite rapidly as we are a relatively young pension fund. For next 3 decades, contributions will be substantially larger than benefits, which means that liquidity is not that big an issue for us. Managing a defined contribution scheme means that we have a very large degree of, let's say, freedom in deciding our investment policy, as we have no guarantees. We have a very soft liability side. You can compare us to many respects with a mutual fund. When people, until retirement, we have each member of the plan has his own account. Returns are distributed every month according to the returns in the collective pool of capital we are managing. When people are retiring, we are converting their total savings into an annuity, a lifelong pension, which is, let's say, the insurance type element in the pension plan. I think that was enough for the short introduction.
Terrific. Eugene?
Okay, good afternoon, everybody. My name is Eugene O'Callaghan, and I'm the director of the Ireland Strategic Investment Fund. And we have a somewhat more complicated mandate. We were originally the National Pensions Reserve Fund, which was a classic sovereign wealth fund, which a big chunk, about 80% of the funds of the National Pensions Reserve Fund were used after the financial crisis to bail out the 2 largest Irish banks. So we were over 20 billion euros. We went back to 4 or 5, we're up at 7 now. But there was a new government elected in 2011, and they decided they wanted to use the assets to invest in assisting the recovery of the Irish economy, rather than necessarily to have them dispersed globally. So after lots of, quite a bit of delay, we finally have a new fund in place, which is the assumed all the assets of the National Pensions Reserve Fund. It's the Ireland Strategic Investment Fund. And our mandate is to invest on a commercial basis to support economic activity and employment in Ireland. So that's dramatically different, obviously, from a globally diversified classic endowment model type fund. So now we're entirely focused on investing in Ireland. And that's a tough challenge. A, Ireland is a very small market. B, every investment that we make has got to both deliver a commercial return and has to deliver economic impact in Ireland. So economic impact, you can think about that as, is GDP going to be bigger as a result of our investment, or is employment going to be bigger? So that means that where previously we had a whole world of choice in terms of investment, and as you'd all be aware, it's hard enough to be a good investor when you have a whole world of choice. Now we have a small portion of the world in Ireland, and every investment has to deliver, as we say, both a commercial return and economic impact. So what that means is that our investments, we can invest anywhere up and down the capital structure. So we can invest in very safe senior debt, where we might, in the modern world, low interest QE world, get 1 or 2% return. We can invest all the way through the capital structure up to investing in speculative venture capital, which might have long-term benefits. What that's meant for us, obviously, as a team, we've transformed. Our team has changed from being manager selectors to being sort of private equity, private credit. We've hired people from investment banking and corporate finance, and quite a number of the individuals who are more global macro markets types of people left the team. So we've had a total transformation. And then in relation to long term, we are, and we can talk a bit more about the specifics later on, we are very much a long-term investor, because the design of the Ireland Strategic Investment Fund, the implication of the design is that it's an evergreen fund. So what it is, it's been seeded with the National Pensions Reserve Fund money, which currently is about 7.5 billion euros, just less. 7.5 billion euros, even though it mightn't sound a lot in the context of the Irish economy, and we invest with people alongside us, typically co-investors alongside us. So we could, if 1 for 1, we would get 17 billion euros, and that's pretty close to 10% of GDP. So actually that's a huge investment program. So that by definition is going to take time. You can't obviously invest a big chunk of GDP in any country and do that quickly. And then secondly, from the long-term perspective, our target return for the fund, I should say firstly, there can be no money taken out of the fund before the year 2025. And after that, only the Minister for Finance can only take out dividend type payments up to 4% of the value of the fund by agreement with us. So we have a veto on dividends, which is pretty helpful. And our target return is about 4%. It will hopefully exceed 4%. So on that basis, we will always hope to earn more than we'll ever have depleted by way of dividends. So on that basis, essentially the design of the fund is evergreen. And so we are absolutely the definitive long-term investor. So that's our fund. We can talk a bit more about the specifics then as we come to the more detailed questions later on.
Terrific. Thank you, Eugene. So we're going to go into the first of the 3 questions. It will be around asset allocation, and we discussed in advance talking about how we're thinking about allocating to assets given the backdrop of low economic growth or low growth generally, with the possibility of rising interest rates. What does that do to how we think about our investment framework? And to the extent that any of the panelists want to comment on how they think about active management versus passive management, they will do so. We'll try to make this a little bit of a conversation amongst the 4 of us, and then, as I said, within sort of 10 minutes, we'll ask for intervention from you all. Stefan.
Me first, right. Okay. Well, so just a bit more context, perhaps, to help understand our problem. And our problem is that because we're a closed fund, and because we know we need to pay out lots of pensioners through until, say, 100 years away, it doesn't really matter, falls in value impact our wealth. So we can, if we can make a steady return through time of, say, 3% real, it's fine, it's easy. But we know it doesn't work out that way. You have paths of return risk is how we think of this problem internally. Of course, if markets go up and then they go down, that's fine. But if markets go down first and then come back up, so you still make 3% on average, I have less wealth by definition. And that's because I pay out money every year. I pay out around 7% of my fund every year. So we have what we call a path of return problem. It's every closed pension, every closed fund has this problem, whether they're an endowment, whether they're a pension fund, or whether they're an insurance company. As long as there's no new inflows, it doesn't really matter. So that means we worry a lot about the paths of return, and we also worry about what the likely expected returns are from any point in time. And so we sort of have a bit of a quandary right now, because deep down we're all mean reversionists at heart. I'm an economist, so I think that the world has to mean revert at some stage. But there's a bit of a problem, because we either live in a world where returns are really, really low forever, and valuations stay really, really high forever. And that's a paradox that you can all figure out yourselves. I don't have the answer to that. Or we live in a world where valuations suddenly collapse in order to bring mean reversion about, to have expected returns rise, and to have the world sort of normalise. And the real problem we've got now, unlike other previous cycles, is that all assets are expensive. So equities, bonds, credit, you name it, it's all expensive. So what do we do? How can we position the fund knowing that we really can't afford to lose money in the near term on the way to better returns, but knowing that we sort of need the collapse in valuations in order to revert everything back to normal? That's the ultimate paradox. That's the problem I think all investors face actually here, in a nutshell. So the way we've been trying to figure that out is we've been moving, just to reflect on the current asset allocation. What that means is that there's been a really big focus on income. Income is sort of like the last defensive asset we have. And so this has pushed us increasingly into more liquid assets. So we have a large private debt portfolio, which we kicked off around 3 years ago, maybe 2 years ago, which is going quite well. More private equity, more property. We've started to buy some ships. We've become ship owners. So anything that gives us an income, anything where we really get to grips and understand properly what the risks are to owning those assets, but knowing full well that we need to take some risk in order to get these returns, but also we know that there's this underlying paradox. We have this problem which we don't quite know. I mean, if it's what some people think of as the risk premium problem. The risk premiums to these assets need to unwind. We just don't know how they'll unwind. Right. And if they'll unwind quickly or if they'll unwind slowly. And that's really the problem we have.
Very interesting. Torben, how are you thinking about it?
Yeah,
you have a slightly different problem.
Yeah, but the same challenge as everybody, taking care of other people's money, how to act in a world with very low interest rates, with a basic scenario saying that we will have low interest rates for a long period of time, low growth, and as Stefan pointed out, very high prices on almost all assets. We have designed our portfolio as a life cycle product where we are reducing the risk level as people are approaching their retirement age. So our young members up to 40, 45 have now almost no bonds in their portfolios. We have dramatically reduced our investment into, let's say, traditional government bonds and increased our allocation into what we call stable alternatives, non-listed assets like real estate and a number of infrastructure assets which can provide us with, let's say, stable cash flows with a yield substantially higher than on government bonds, but with a very low correlation to the overall business cycle or the listed equities, in order to, let's say, stabilize the return and also to, let's say, increase the risk capacity in the overall portfolio by introducing assets with a very low correlation to the listed market. We have now approximately 10%. And the second thing, we have, because of the low yield environment, we have increased our focus on designing vehicles which are more cost effective or low cost than traditional private equity structures. So cost is a very important issue for us, and we have, during the last 5 years, increasingly moved into assets where we either make investments directly from PensionDanmark or enter into, let's say, club deal structures with other like-minded investors in order to avoid the high fees in the, let's say, traditional private equity type industry. So we have now approximately 10% of our assets as direct investments into real estate, and we have a team with, let's say, special competences in this area. They are from the engineers, people with a very different background than what you normally see in the investment department of a pension fund. And we have other 10% allocated into direct investments in renewable energy infrastructure. Actually, now we have become a relatively large owner of not ships, but of on and offshore wind parks, biomass power plants. Now we are not only a pension fund, we are also some kind of energy company, because we have now owned approximately 2,000 megawatts of green energy capacity, many of them actually in UK, which, just to make this little extra remark, that this has proven to be a very effective issue in the communication with our members. Now we tell our members that we're not only providing you with good pensions, but also with green energy. So when you put on the light in your house, it's green energy from your own pension savings, which are providing that. That's a very it's a good story line in our communication with members. But we're looking for infrastructure assets which can provide us with stable cash flows, and that's been our reaction to the challenges provided by the low government bond yields. So now we have, I think, 35% of total assets are now in non-listed assets, and probably we will increase this allocation to somewhere between 40 and 45% during the coming years. This also means that pension funds increasingly will play another role than in the past. We will be direct investors. We will have to develop our skill sets in order to be asset owners, not only portfolio managers. And we will see an increasingly development of, let's say, club structures where pension funds are teaming up together in order to get access to interesting assets. But of course, also here it's a competitive market, and the challenge is that we're not the only one doing this. So the asset prices are rising also on alternative infrastructure assets, which may be the creation of the next bubble. That's our main worries.
Right. Can I ask you one clarifying question? Did I understand you properly that you have, because you have different ages of your members, you actually have two types of portfolios. You have portfolios for your younger members. I noticed you said up to 45. I was thinking up to 55. And then the older members.
No, actually, it's very simple. We have a portfolio for young and for the elder people, and then we, for those between 45 and 70, we interpolate. So they have an individual portfolio which is a combination of the portfolio for the young one and for the elder one.
Okay.
So actually each generation or each has his own portfolio with its own risk
Risk and return profile.
That's the
And you all are running one portfolio, is that right?
That's right.
Pretty much?
We obviously don't get older Auxiliaries
Yeah.
in Denmark. But, yeah, it's just a single fund effect.
Right. Eugene, I've been looking forward to this answer all day because you have a tricky problem.
Our asset allocation challenge is a bit different because it's not an asset, it's not a return optimization challenge we face, because we have this double bottom line of both commercial return and economic impact. So, the question is, how do we trade off, one against the other? And if we had lots of return but no economic impact, that's not going to keep our political stakeholders happy. And equally, if we have lots of economic impact and fritter the money away, that's not something we can do, we want to do either. So it's a question of how we trade off that, excuse me, trade off those two objectives. We do have, as I said, a target return of 4%, and that was that's driven by the cost of Irish government debt. Or it's based off the cost of Irish government debt, and if we can get 4%, we will sort of pay our way, as opposed to using the money just to pay down some of the sovereign debt. But that 4%, maybe conventionally or historically, might have been a fairly soft return target, but clearly in a world of QE and low yields, it's a harder or tougher target. But even still, it's not as tough as a return optimization target in pure money terms. So ultimately, we're going to have a mixture of debt-type instruments and equity-type instruments, and the debt could be, anything, as I said, from very safe and secure, which would only yield 1 or 2%. It could be through investment-grade credit, all the way through to maybe lending to SMEs, which might yield, 5 or 6 or 7%. And the equity, as you'd be aware, can obviously deliver, whatever return it delivers. But ultimately, we are going to have a mix of debt and equity. And that, the reason being, one of the things that we've observed is that debt actually delivers much earlier economic impact than equity. So if you think about investing in growth businesses, it takes quite a long time for substantial economic impact to come through, whereas we can invest in an infrastructure project and there'll be lots of construction jobs straight away if we provide money for that, and there's a sort of an enabler across the economy, a sort of a benefit from that. So what we're finding is that debt projects which have lower return often have certainly more immediate and sometimes more attractive economic impact. So that's part of our trade-off. The second aspect of our asset allocation then is around, we have to invest in Ireland. We've no choice about that. So clearly we have to make the best fist we can of that problem. And so we're looking at building our asset allocation, and we're still only in the early days, so we haven't concluded this, but we will definitely be building an asset allocation and a portfolio which will try to diversify us as much as possible against the different economic outcomes there may be over a 10 to 20 year period. So this is really, we don't know how QE is going to unwind. Will there be lots of inflation? We don't know if low yields imply long-term, like Japan, there could be low growth for a very long time, or QE might work and growth might rocket. So we're trying to develop a portfolio of assets which will give us the most resilience to the different economic scenarios that might unfold over the medium term that we don't know what they are at the moment. And this is all about achieving a balance. It's sort of common sense, but it means that, for example, we might we're definitely at the moment short on assets that might do well if there's very high inflation. So, we might consider, or what we are considering is, can we convert some of our nominal debt into inflation-linked debt, for example? That type of, there are portfolio construction techniques that can be applied to that. And the third aspect then to our asset allocation is really around the essence of us being a strategic investment fund, and we want to focus on sectors which are important to the Irish economy, or where we can actually generate return. So this comes back down to, firstly, where does Ireland have competitive advantage, or where is there opportunity in Ireland, financial opportunity that will contribute to economic impact. So traditionally, a bit like Denmark, we're a very food and agriculture driven country, and so we have specialists in our team, and we're working on a particular portfolio, allocating to areas where Ireland does have. We have a geographic, it rains all the time, as any of you who've been in Ireland will know, and that's good for grass, and that's good for dairy products, for example. So we have a competitive advantage there. We're also looking at, clearly, in the context of the energy sector, there's a lot of renewable potential in Ireland. The wind blows quite a lot on the edge of the Atlantic, and over time, hopefully we will be able to harness tidal power and things like that, because we have an island with lots of coastline per head of population. So tidal energy is not yet cost efficient, but it's getting there. So we have a sort of an asset allocation which is driven by the sectors where Ireland can potentially have competitive advantages, and so that's a third dimension to our construct. And it's really putting all that together, the conventional asset class plus the economic scenarios plus the specific sectors, And it's to try to bundle all that together in a way which creates a sensible portfolio, which in a broad sense is sensible against those three objectives, but won't be optimized against any one of them at all. It's impossible to optimize against all of that.
Terrific. Well, I might just open it up to you all. Do you have questions or comments on asset allocation, what you've heard? Yes. If you could do us a favor, just quickly introduce yourself, that would be great as well.
Sure. So it's Trevor Castledine from Lancashire County Pension Fund. I just wanted to dwell on the risk aspect of, the danger of losses to capital and the impact that has in a different way on all three of the funds. And just to ask whether allocations to volatile assets like listed equities were done through physical holdings, or whether they were done synthetically, or whether any insurance or protection was put around them using derivatives, or whether you found that not cost effective. That's
a terrific question. Who would like to?
Well, I can take that question clearly in the context of a long-term fund in Ireland that has, is a very big fund for Ireland. Listed markets are very small, and all of our assets, typically, or nearly all of our assets, will be private market assets. But we do have an interesting example in our transition, where we have, had to transition over. It will take 3 to 5 years, a global portfolio from a classic global portfolio, and to make sure that we don't lose much money on the way through, so that the 7 or 7.5 billion is available for investment in Ireland. And we have, in the last 2 years, as we've known this has been coming and implementing, we have both reduced our equity weighting, and we have bought equity put options. Typically, and this is because we've had a short-term time frame. We've bought them about 5% out of the money, but that has protected us against big losses in equity markets. It has been, not overly expensive, because volatility and therefore options pricing has been, reasonable, I suppose, as opposed to exorbitant. But we have concluded at the same time that, we've done some further work on this, and we're probably in the fairly near term going to be dropping our options strategies just purely because of the cost, and we'll probably put a very conservative asset allocation in place now for the remainder of the transition period. But certainly what we have found is where our stakeholders have been really sensitive to the size of the fund, and as the fund has been formed, that the options have worked really well in terms of giving us a very stable return, and there's been very little reduction in value, and we've had, through every quarter all the way through the last number of years, we've had, positive returns. So I think I would certainly be a recommender of options for people who have sensitive shareholders, stakeholders, and a relatively short time frame.
Well, we do use them. Maybe just a bit more context. We forecast the returns of everything we own as a rule. So if we can't forecast it, we don't own it as a bit of a rule. And so when it comes to the equity side, we'll have a forecast for the equity by country. In equity space, we forecast by country. So what we'll do is we'll say, is there a better way to own that allocation than physical? We always start at just owning the physical beta, basically, the ETF, if you like. And where the market can trade, can give you the synthetic idea for free, inverted commas, like cost us, selling some upside and buying some downside, then we'll look at it. Although it's very difficult, because obviously you give up the dividends as well, and right. Also in a zero rate world, you're not being paid for having the cash at the sideline either. So it's quite hard to do. I mean, we've done some of this in the past, and we've also allowed ourselves to trade out of parts of it too. So that what we've ended up with in one case, we own just a call instead of owning physical equities. It's actually worked out quite well. That's nice, but eventually that rolls off, and you've really got to make sure that you're. I think the issues I'd have here are, one, be aware that you do lose return through them. I mean, it's not free. Options aren't free. And secondly, don't let it get in the way of what you think is the right asset allocation. Don't let the options drive what the assets are. Make sure that they're there as a way to fulfill your strategy, not the other way around. I'm probably echoing a bit of what you're thinking.
Do you want to comment? Or, other questions? Okay. Thank you.
Good afternoon. Scott Young, Gemini Capital. Maybe for you, Eugene, and also David, given your generation fund. Impactful investing. Are you willing to give up a bit of yield for something that could have an extraordinarily positive impact on the environment, health, whatever, but for waiting a bit longer you might otherwise? Thank you.
We are prepared to invest in different asset classes and to have an overall lower portfolio return in return for the impact that we're looking for. But every individual investment, according to our legislation and also enforced by EU state aid rules and so on, because we're a national fund, has to be commercial, so it has to be commercially priced. So we're not actually able to consider any soft money, and there are different government departments and agencies that might do that if that was necessary. So every investment is commercial, but at an overall portfolio level, as I said, we would have, we'd quite happily forego some equity return and have a debt return instead if it meant good economic impact.
And at Generation, we do not trade value for values. We fundamentally believe, and we'll talk about this in a few minutes, that sustainability allows us to make better investment decisions. And so we would argue that there's no trade-off whatsoever. In fact, we insist that there be no trade-off. I think we might, speaking of trade-off into risk management a bit. And it's sort of a cliche to say, well, have you thought about risk management differently since the financial crisis? So I'm actually not going to say that per se, but given there certainly is a lot of volatility, there's a lot of change in the markets, there's a lot of worry in the markets today, and I would say that this seems to be had been true for a number of years now. Has that affected how you think about risk management? Do you have specific strategies that sort of reflect a zero interest rate environment with the possibility of interest rates going up, the geopolitical challenges? Is that change your framework, or is it just back to fundamentals and how you think about risk management? Yes, please.
I mean, that's sort of another view on how we do things in a way. I mean, so when we forecast our expected returns for our assets, we forecast them in 3 or 4 key scenarios, like normalization or low growth or high inflation. And that allows us to worry about key, what I call economic risks. So what we're doing is we're saying, what are the economic risks of waking up in this alternative world or that alternative world, as opposed to what we think might be the baseline world of normalization, say, or something. And what's interesting when you do that, and in spite of all the people who have studied portfolio theory that manage portfolios, is that you see that it's very, very hard to diversify away your economic risks. If the economy tanks, everything tanks. I mean, bonds will do well, and unless you're prepared to make 100% of your portfolio bonds, you're highly unlikely to make that call right, and you're highly unlikely to be able to have your whole portfolio geared that way. So it's very, very hard to create a portfolio that diversifies away economic risks. It doesn't mean portfolio diversification doesn't work at a portfolio level.
Right.
So when you get your smart guys that have 30 stock portfolios and they follow markets, they do create diversified portfolios, but certainly in an implementation space. So how we think about this is we say, well, what we try to do is we try to identify the key economic risks, be aware of them, and then just be aware of what might go wrong to asset classes we have if those economic events happen. So it's not so much trying to be reactive, but trying to say, well, are we sure we want to own this asset in that example? And say, I mean, when it comes to, say, shipping, for instance, our big risk is that world trade collapses. Mm-hmm. Well, that's a risk we take, and therefore we go into it. So I don't think we think differently about the risks. I do think, though, we try to be very careful about saying there are economic risks, and we just need to take those risks and be aware of them and take them in measured ways in the portfolio. But as a result, I certainly, this is a very personal view, don't think that diversification per se helps you at the strategy level. I think it's very, very hard to add those things up.
Well, also recently we have tried to design our portfolio as we call it an all-weather approach, where we have used the combination of
an all-weather
concept to reduce the overall risk level and stabilize the returns by using a combination of a high allocation into equities with our bond portfolio. But now with very low bond yields, this mechanism doesn't work any longer. So we have gradually moved away from this, let's say, balanced way of using bonds and equities into a more absolute return way of thinking, and are trying to, let's say, reduce our both formal but also mental focus on benchmarking. So very much like Stefan, we are looking at each asset or asset class and saying what's the value in this investment for our stakeholders, and try to reduce our dependence on benchmarking, let's say, so tyranny. But it's difficult, and as we are gradually moving away from into the non-listed markets, we have to deal with other type of risk, where political risk has risen in our way of thinking. When we are making investments in renewable energy infrastructure, they are very dependent on the stability of the regimes of subsidies. So that's why we have reduced our investment area to Northwestern Europe and US in order to avoid political risk associated with making those type of investments in, let's say, Southern Europe or in emerging markets. But so political risk is a more important issue in our overall risk assessment than, let's say, 5-10 years ago. Another way to mitigate risk is to enter into public-private partnerships, where we are trying to identify structures where we can, let's say, distribute risk among partners in the construction in a way that where each partner actually takes on the risk which is best suited for this partner. For example, when we are involved in building a construction and operating an off-sea wind farm, it's now common that the provider of turbines, let's say Siemens or Vestas, will take on the risk for the performance of the turbines. So as an investor, we have, let's say, mitigated a large part of the technological risk to the supplier of the hardware. When we are, as a similar example, we want to get some kind of exposure to direct investments in emerging markets, but don't feel that we as a pension fund can deal with the political risk associated with being a direct investor. So we have teamed up actually with the Danish government. We have established something we call the Danish Climate Investment Fund, which is a blended finance vehicle with government money and pension fund money. From the government point of view, they get leverage by inviting us on board. We get some kind of political protection because when we are investing, let's say, a wind farm in Kenya through this vehicle, we are assured that the government of Kenya will not be, they will be playing a very risky game if they will change the power purchasing agreement with the Kenyan electric authorities, because they will not only hurt a distant Danish pension fund, but they will put their relationship to the Danish government, a very big donor for Kenya, at risk. So this is some kind of political insurance or political risk mitigation, which I think will be more important in the future. But so moving from portfolio management into more absolute return focus, and trying to develop skills to assess new type of risk and enter into partnerships where you mitigate risk to other partners. That will be
very interesting. Eugene?
We would have just two observations on risk. The first one actually is around the importance of governance of the fund in relation to risk management. You know, as we said, we're a long-term investor, and as a public fund, it's really important that the that we aren't subjected to undue political pressures to invest in X or Y or Z, particularly a domestic focus fund. And so, you know, I think we have a governance designed for the fund which insulates us essentially from politicians and political influence. And, you know, the various investment committees and boards that, you know, oversee us up the line are comprised almost entirely of non-executive individuals who are expert in investment or finance or business management or whatever. So governance, you know, I think at any level it's certainly been a strong lesson I've learned that, you know, the governance is important to ensuring that the risk profile ends up being sort of appropriately aligned with whatever formal mandate anybody might have. And the second comment is around very much as a sort of long-term investor, and particularly also a private markets investor, our concept of risk has really moved towards one of permanent loss, and permanent loss is to be avoided. So, you know, volatility is out. And,
almost
you know,
always.
Sorry?
Almost always it should be avoided.
So volatility is out, and permanent loss is what we're seeking to avoid. And clearly that means that, you know, certainly in my experience, leverage is a huge part of permanent loss. So businesses that are over-leveraged, projects that are over-leveraged, that's where losses occur. There need to be equity buffers. In growth companies, there needs to be enough equity that it can take twice as long as base case to build up the revenue to the level, you know, to base case revenues. Instead of it doing it in 2 years, it takes 4 years and so on. And in relation to, you know, leverage on you know, infrastructure projects, real estate type projects and so on, it's really important that leverage be prudent, so therefore there is no permanent loss. Because ultimately, even through very, very serious declines, you know, as we know, asset markets can bounce back pretty quickly after serious declines, and the people who really lose money are the people who lose control of their assets during that period. Anyone who kept control of their assets even through the global financial crisis, you know, even I know in the Irish residential market prices were down 60–70%, but they're back up to 80% of the peak now. So if you had no leverage, you'd nearly have your money back after 5 or 6 years later through one of the worst crises imaginable. So, you know, most cases, it's really just, so we're really focused on avoiding, you know, ensuring prudent levels of leverage and avoiding, where possible, the possibility of permanent loss.
I would echo a couple of things here. One is that the biggest risk you have is not meeting your returns, your required returns. And we so often lose that in all these risk frameworks. And secondly, volatility is not a measure of risk. It is, I mean, is one of the, it drives me nuts for us internally to start talking about it. And we do not use it. Volatility is not a good measure of risk. And I think it's just echoing what you're saying there.
Interesting. Questions, comments, participation? Yes. Faith.
Hello, Faith Ward from the Environment Agency Pension Fund. Leading on from some of the comments that were made over lunchtime, and both in terms of asset allocation and risk management, to what degree do you feel climate change has had an impact on your risk metrics or how you might look at risk, particularly in the long term, the nature and title of this session?
Who would like to?
Well, as I said before, we have, let's say, tried to capitalize on the focus on changing the way you are producing energy towards a more sustainable way, and are now a very active investor in renewable energy, both on production facilities but also in transmission facilities. So, if we are to decide between two, let's say, competing investments, let's say a fossil type of investment and a renewable energy type of investment, we will, if the overall risk-return profile is similar, we will of course opt for the renewable energy asset in our investment. The same goes with our investment in real estate. We have, for 5 years ago, decided that all our new, let's say, office buildings are to be classified as sustainable buildings by using of materials sourced from the local neighborhoods, and by constructing these new facilities as very energy and climate effective. That's not only an CSR dimension, it's also a good business case, because energy effective office buildings can attract the most attractive tenants. The total cost of operating such a building, if you take into account the reduced energy costs, is actually more cost effective than traditional constructions. So we can combine the focus on our obligations to act as a sustainable investor with actually also identifying very attractive investment cases.
Can I just
Yes.
a very quick comment? And this is designing an environmental and social and such strategy is no easier than designing a typical investment strategy, right? So this is hard to do. But I'd make a couple of observations. The first one is, I'm sure if you wanted to turn on electricity for almost everyone in Africa, the quickest way to do it is to build a bunch of coal-fired plants. So if you want to deliver good outcomes for most people in the world currently that don't have the great standard of living we have, you're going to have to think about doing it in perhaps a non-environmental way. And there's a problem with that. Now, my second observation is that it seems interesting that the people on the ground seem to be helping us answer this problem. So it's investors, it's people at the technological side, it's people at the face of these markets who are creating the ideas that get around these problems. So I think it's very difficult for us to sit here and go, well, actually, we've got the great ideas to help with all the sustainability problems in the world. I think we need to really rely on the people on the ground, the scientists, the people who are creating these new markets, whether it's for electric cars or for different solar panels and so on, to do that and back them, and to back people with these alternative energies and these alternative ideas. I think that's our role here.
Well, this allows us to transition into the conversation around sustainability. Is that okay, Eugene? Because I know that you're going to be able to participate in this one, and you'll go first. How about that?
I don't know.
When I retired from Goldman Sachs about 12 years ago and told my partners that I was going to retire and start a sustainable investment firm, they said, well, this confirms what we always knew about you. You're a nut. And it's 12 years on, and it may still be true that I'm crazy, but it's also clear that the conversation around sustainability has evolved quite significantly over these 12 years. And to make it even a conversation of an important convening like this, I think tells you how far we've come. And principally, the reason behind this is not because it's around values, although values do matter in certain circumstances, and certainly in our lives it matter all the time, but because the business case for sustainable investing has become very compelling and very robust. Now, that doesn't mean that everybody in this room agrees with that, and even my colleagues on the stage. So what we wanted to do is just spend the last 10 minutes and talk about whether it does make sense to have sustainability, environmental and social governance as part of your investment framework, and if you think it does, how do you do that? And Eugene, I know that it does in your case because you've already talked about it. Maybe you can start us off.
So we have been proponents of sustainability and ESG approaches to investment for quite some time historically, when we had a global fund and we were among the founder signatories to the Principles for Responsible Investment. So, and nothing has happened over the years that would change my view that that's a very important way to invest. Techniques and methods and services have emerged which have assisted investors in listed market or in listed securities, public markets, to apply ESG principles. Our problem, I suppose, with our fund having turned into a domestically focused fund is that none of those products, services or techniques really apply to private equity and private credit investment, or to nothing like the same extent. So we're really trying to I think, logically and rationally, we're, big supporters of ESG and incorporating ESG factors into decision making. How we do that on a systematic way across a whole portfolio of private market assets is something, to be honest, that we're still trying to figure out. And, we also have further conundrums within that, going back to the climate change question. In Ireland, the biggest contributor to carbon emissions are farm animals. And on the other hand, we have a very strong food and agri sector, as I was saying. So how do we invest in the food and agri sector when they're the biggest contributors to climate change, to Ireland's CO2 count? So, we haven't actually figured that one out yet. So, we're really, we want to try to implement ESG principles, but how we do it in our context and in our mandate, we're still really are. I'd be delighted if any of you had any good ideas on that front to help me.
I do.
But I think for a long-term investor taking care of other people's pension savings, I think it's very. You have to be the opposite is not an option. You have to be a sustainable investor. I mean, the young worker aged 20 who started paying contributions to our fund yesterday will be around on the other side of year 2100. I mean, so we have an obligation to take on a long perspective when we are investing our members' savings. But I also agree with the moderator that this is not something we have to choose between being good and being doing good business. I mean, a number of investment cases in the sustainable area are, from a competitive point of view, outstanding compared with, let's say, non-sustainable investments. I mentioned before what we have been doing in the area of renewable energy infrastructure and in our real estate programs. And I'm really convinced that if we want to be a long-term owner of, let's say, office space in our part of the world, you have to go for the most sustainable climate energy effective construction techniques in order to protect the value of these investments. We are practicing ESG policies on almost all our asset classes, but I agree with Eugene. It's easier to do that on the listed equity area, where you can engage and you can make decisions on the annual meetings and things like that. But I think gradually we also find a way to introduce these kind of techniques in the private equity and in the credit market. And I think there's only one way forward. There will be more focus on sustainability and ESG in the future than now. Yeah.
I think I said what I said before, which is that this is very, very tough. And I think trying to figure out what sustainability adjusted returns look like is very, very difficult, if you know what I mean. And I don't know if we're there yet. But also, we just have to be aware that what's right environmentally for us in Europe might not be right environmentally for the outcomes for people elsewhere. That's just something I don't think we've come to grips with. But there was an interesting article in The Economist about this week, I believe, about having people that build ESG providers make the case to business in a stronger way in order for business to take it on and bring it on. So I think this is coming.
Mm-hmm. Well, I will send you a op-ed I did in the Observer on the question of coal in Africa.
Sure.
That will help out. Questions? Yes.
Hello, Ekaterina Sharshidze. Through our, we have a family office, and through that we have a sustainable investment platform, Ludgate Investments. And my question is to David, as well as others on the panel, how do we actually dispel the myth that sustainability has to be at the cost of returns? And then in turn, how do we convince the pension funds and others to invest more? Because at this point, there is not many data points. And because there's not long history of investing in this space, it's a vicious circle. Less money is going into it, so there's less data to create to invest more money into it. So you have done a great job of doing that, and maybe you can tell us how to do that.
Well, thank you for saying that. I don't know about that, but I think Stefan made a really important point just a second ago before I was being flip, and I apologize for that. The most important thing that those of us who are passionate around sustainable investing and sustainability can do is to make the business case why it makes sense. What are the economic implications? What are the risk management implications? What are the resource management implications? And that's taken a while, but the case around that is becoming extremely compelling. The second is, as a fund manager, the most important thing we can do, it's actually not writing or speaking or the advocacy work, is to deliver outstanding investment results. And we're not confused by that. And so we hold ourselves to the highest investment standards there are, and that's how we intend to compete. And we've been lucky, I think, but also maybe somewhat smart about being able to prove that, in fact, you can do very, very well and at the same time be sustainable. But it's making the business case, fundamentally making the business case.
I think there's one other point to that. I think it's important that decision makers should be prepared to trust their sort of logic and reasoning where there's not enough data, in a sense. If you're a long-term investor, sustainability can make sense, and it should be, I think people should be more willing to trust their analysis and their logic and go with something rather than wait for data which won't be there for 10 or 20 years.
Our experience is that in the ESG universe, it pays out to focus on the G, on the governance issue, because good governance, for sure, in general also is followed by good practices on the environmental and social issues. So, looking for good governance, I think, is the easiest way to become a sustainable investor. Yeah.
My name is Steve Plummer, Transform Global. I was really excited by your public-private partnership example, but that's often done on a deal-by-deal basis. And my question is really to do with the capacity-building problem, where capital is not flowing to the many, many early-stage entrepreneurs that are trying to do sustainable development, sustainable innovation, developing the technologies, the business models that can address these issues. So my question is, do you believe there's a mechanism to, rather than do it on a deal-by-deal basis, create new fund structures that reinvent venture capital? For example, evergreen structures, blended structures, where you're actually investing appropriately for a long-term investor with your the constraints, where you're pulling government, impact investors, and others alongside, create much more sustainable mechanisms of tackling that access to capital issue, which is a huge bottleneck. Do you believe it's possible, and are you interested?
Well, I think it's necessary, and I think that we in these years are at the brink of a breakthrough in blended finance structures where governments and private investors are teaming up. I mean, governments all over the world are restricted by hard budget restrictions, where budget policies. Investors are looking for yield returns in a low interest rate environment. So to combine our need for getting access to new type of investments with the government's need for attracting private capital as the public capital or public expenditure is restricted is, I think, the way to go forward. And I think in a few months' time we will have the COP21 in Paris. It will focus very much on how to mobilize both private and public, but especially private funding to the emerging markets, to the developing countries. And I think the only way to meet the ambitions is to develop through blended finance, PPP type of structures. I think there's a big role for pension funds and other long-term investors in this area. Yeah.
You have the microphone. You've got 15 seconds. Go for it.
My question's about governance and how pension funds can impact more on companies. I mean, every year we have a major failure in governance. We've had Volkswagen, we had Tesco last year, BT rumbles on, and there's been many others. I mean, you as major pension funds, how do you exercise influence over companies in order to strengthen their governance to try and avoid these situations going forward, which clearly just erode shareholder value?
It's a great question.
Can I maybe offer you a controversial answer? And that is, it's the role of boards to manage their companies. And I had a great debate about with the McKinsey guys about this, and I think we're on the wrong track about this. We cannot take the place of the good people on the boards of companies who are meant to run their companies properly. We can influence, and I'm sure there's lots of influencers in the shareholders that can do that. But we should not fool ourselves that I or anyone else or any other pension fund should go out and hire hundreds of analysts to do what we think is the right analysis on a company, and then to march into a company and maybe demand a board seat or something. That tips governance on its head, in my view. If the governance of Tesco's is bad, it's bad because of the board of Tesco, not because of me.
But
I suppose I come back and say, well, how do you, as a potential shareholder or a shareholder at Tesco, actually satisfy yourselves that actually the governance is robust enough?
Well, you're right. There are questions about how we, I guess, engage with them, and there are things. And the problem you've got is how do we, as individual shareholders with finite resources, ultimately, ascertain, judge, and decide what's right and wrong. Okay, so a simple way of doing it is we do it through governance procedures like Hermes EOS and that sort of stuff. But I think we have to rely on activist shareholders getting involved, right? Because those are the people who have set themselves up to do that job quite specifically. And then we have to rely on good advice from people like Hermes to say, well, actually, that board member's been a bad board member. Let's vote him or her out and bring on someone who's better. But I really struggle with the logic that I at Cole and a bunch of other people at Cole are going to be able to have a strong view about specific companies in an index that when they get whittled down are actually quite small allocations of my overall portfolio.
maybe just one other comment before we conclude is that, these are very fair comments and great question. Another way to think about possibly would be to say, can you use an analysis of a board to help you make a better investment decision? And I think the answer is categorically yes. My experiences over these last 15 years of sitting on boards, both for-profit and not-for-profit, is that it gives you tremendous insight in the possibility of success. A great board, a great chair and CEO can be very effective. Bad boards can be terrible for the success of business, and you can figure that out, actually. Anyway, I want to thank everybody for being here. Thank you very much to the panel.